Ms. Karen Lee from ALOG, CEO, I welcome you to this fire chat. I just want to invite you. I thought of inviting you for this chat because there has been some, talk in the marketplace, both in the media, and there have been also the proxy advisors who've been asking your unit holders to vote against the deal. There have been developments since then. It'll be good to therefore look at the overall picture and look at how you can, talk to the unit holders as you would talk to me on some of their concerns, which I will raise. Let's kickstart the conversation by asking you, what is the rationale for this merger?
Right. Thanks, Mr. Gerald. And first of all, let me take this opportunity to wish everyone a prosperous year of the Tiger.
Yes.
And thank you, Mr. Gerald and SIAS, for giving us this opportunity to discuss the proposed merger. Yeah. Let me start off by discussing why we need this merger in the first instance. As we all are aware, there is this acquisition of ARA by ESR Group. So once the acquisition has been completed, which was early last 2 weeks or so, what happens is that for us to continue to be able to deliver the value for our unit holders, we need to consider the long-term strategy for the REIT itself. So earlier on, when we were standalone REIT as ALOG, we had exclusive and a dedicated sponsor, right, from our current sponsor, LOGOS. So right now, with this acquisition completed at the sponsors level, we now will be sharing a common sponsor with ESR-REIT. So with that in mind, we think that it may not be an optimal solution we need to find an optimal solution for both REITs. And if we are on a standalone basis, so what happens is that, the two REITs have some form of overlapping mandate. ESR-REIT is a diversified REIT. They have assets in logistics and non-logistics, whereas ALOG is in the pure logistics space. So there's some overlapping mandate there. And we will be competing with each other because now we are sharing the same common sponsor. And it will be unavoidable to have some form of conflict of interest from both REITs, right? So right now, what we want to ensure is that we want to make sure we are able to continue to grow in size, merge the two REITs, and able to tap on the sponsors for its common resources and financial resources as well. So that was the original motivation of why we want to do that. On a standalone basis, ALOG is currently still a small REIT. While we believe that we are still able to grow, but on an enlarged scale, we will be able to grow faster and quicker. And because with an enlarged platform, our debt headroom, development headroom, and capacity to source for funding will be further enhanced. So hence, that's a key reason of why we decide to explore this merger with ESR-REIT.
So there is a doubt in the minds of some people, some unit holders, whether the board has negotiated enough for this merger in terms of the offer price. Does it sufficiently compensate ALOG unit holders to give up a logistic pure play and merge with ESR-REIT?
Mr. Jared, that's a good question. I would like to highlight that, this revised scheme consideration for the merger that we have received is the result of extensive discussions between ourselves and the ESR-REIT manager, and it's all negotiated on an arm's length level. So throughout this process, our independent directors have also been advised by reputable and experienced professionals, and such as the independent financial advisor, our financial advisors, lawyers, and accountants, to ensure that the process is in compliance with applicable laws and regulation. So the negotiated terms were ultimately approved by the ALOG directors of ALOG Manager, who are independent for the purpose of this scheme. And the independent directors have also preliminarily recommended for ALOG unit holders to vote in favor of the merger. But given this is a merger, the relative valuations of both ALOG and ESR-REIT has to be balanced from the perspectives of both sides of their unit holders. So if the merger is approved, our unit holders will continue to be invested in the existing portfolio of ALOG assets, and this will form part of the enlarged REIT. And at the same time, our unit holders are able to crystallize some of their investment returns in cash. So they exchange part of their units for ESR-REIT units, but yet they take back some cash as part of this proposal. So if you look at the revised proposal itself, it has improved. The scheme consideration comprised of cash and consideration units, and the cash consideration has actually increased from 95 cents to 97 cents. And the consideration units has increased from 1.6765 each new ESR units to 1.7729. So and we have also included an analysis why we think this is compelling. The illustrative value of the improved consideration is now 93.3 cents based on the 1 month ESR-REIT VWAP. This is also taken from the guidance from the PROXY advisors report. And with this, there is the whole illustrative value scheme has increased by 5.3% versus the original offer, comparing on a like basis using ESR-REIT's 1 month VWAP. And I would also like to highlight that, this illustrative value per unit represents a premium of between 0.5% to 31.2% when we compare against ALOG's 1 month to 12 month VWAP. Again, this is also taken guidance from the PROXY's advisors report, where they suggest us to look at the ALOG's VWAP over the various periods. And most importantly, I want to highlight that the revised scheme represents a 37.6% premium to ALOG's NAV. And this is the highest premium paid for any precedent S-REIT merger and S-REIT privatizations. So looking at the historical pro forma DPU accretion to ALOG unit holders, which has increased significantly from 8.2% to 12.8%, and the historical pro forma NAV per unit accretion to ALOG unit holders has increased from 2.2% to 5.3%. So beyond the above, the board has also considered the full context and considerations of the merger, which has included the various benefits that we have been articulating, and also some limitations associated with remaining as a standalone REIT. And I've alluded to some of the limitations earlier on. So at the end of the day, we want to make sure that both REITs can come together and grow as one of the top 10 S-REIT in Singapore, instead of competing with each other.
Yeah, I mean, you have the big picture in here before us, but Karen, there is a feeling amongst ALOG unit holders that you have not been in touch with them regarding the concerns. They feel that you have waited for the PROXY advisors to recommend to revise the deal, to get a revised deal from ESR. So the key reason for the proxy advisors to come out there and market and say vote against is that it is not in favor of the ALOG unit holders, given that ALOG's trust properties portfolio had a higher concentration of new economy oriented properties than ESR-REIT, So said, okay, that's the first complaint, all right? And that you will deal with now. And the second complaint is that you have not shopped around and that you have been not in a position to look at alternative other offers. Could you have canvassed for alternative offers? So let's take each of these concerns, complaints, so that you can assuage your unit holders.
Yeah, sure. Mr. Jared, let me address the first question relating to the proxy advisors report.
Yes.
Actually, in fact, we have been actively engaging our investors since we announced the merger in October last year.
Okay.
And most of our, in fact, our institutional investors especially do understand our rationale for the merger and the long-term potential benefits of an enlarged platform.
Yeah.
In this regard, we have also received an irrevocable undertaking from Ivanhoe Cambridge, one of the largest institutional unit holders, demonstrating their confidence in the long-term growth potential of the enlarged REIT.
Yes.
The proxy advisors report flagged the need to present more information as to the process leading up to the merger and the alternative options to be considered. And this feedback only came about, I think, after we issued the scheme document close to mid-January. So once we receive the proxy advisors report, we immediately take their feedback on board, and we have in our latest announcement shared further on, what are the alternative options that we have considered that's suboptimal. Hence, that's why we did not explore further. And we have also explained our independent process in respect of the negotiations with ESR-REIT on the merger. But bear in mind, the original proposal itself is already DPU accretive and NAV accretive to our unit holders in the first place. So I just want to highlight that. And with the revised scheme, the NAV and DPU accretion has been further enhanced. So I think we should not forget that the original consideration has already been accretive to our unit holders.
Yes. So unit holders still are concerned if the manager and the board have negotiated enough for the merger in terms of the offer price. Does it sufficiently compensate ALOG unit holders to give up a logistics pure play and to merge with ESR-REIT? Is it enough? They ask, how confident is ALOG in getting unit holders' approval? Is there room for more negotiation? Improvement in the offer price?
Yep. I think maybe let me just, Mr. Jared, let me just address the questions surrounding, we are now a pure play logistics asset.
Yes.
So why do we need to do this merger? So I think first and foremost, we need to understand that with the rapid expansion of e-commerce, digital transformation, and rapid development of technology companies, these have driven strong appetite for new economy assets. And we believe that this is the growth, or this is where the growth will be, and a sector that ALOG should pivot to. So while ALOG currently is a logistics pure play REIT, but we do not have high specs assets. High specs assets support high value add manufacturing, which are important in the ecosystem driving economic growth. We think that there is sustained demand for high spec space driven by the growth in the manufacturing and electronic sectors.
Right.
So on the other hand, ESR-REIT being a diversified industrial REIT with the portfolio comprising of high specs and some logistics assets, there it is a good platform for us to combine into, so that we can together capture the benefits from both asset classes to ensure long-term growth, fundamentally underpinned by the top quality of the tenants that we both REITs have.
Yes.
So with a more diversified portfolio, we will then be able to offer a more complete solution to our tenants across diversified asset classes. And we believe that this will certainly promote tenant stickiness. We can also become a one-stop seamless solution provider for our tenants. And the merger will allow us to be better equipped with this combined platform to cater a diversified real estate solution to capture shifts in requirements for demands as the world recovers from the pandemic. So we are also trying to get ready for the growth post-pandemic by having a diversified asset class. And we are very confident we are able to do so because we are now tapping into sponsors' strong 59 billion new economy pipeline and 10 billion work in development pipeline, plus accessing our sponsors' platform in asset management, investment management, and development to further enhance our ability to meet these new requirements or demand. So our sponsors' diversified tenant network and global presence will be another advantage for the combined REIT to tap into to grow our tenant space. Yeah. So this is...
So basically what they are hearing from you is, look, by this merger, you're going to look better, you're going to earn better DPU, and the future for you is good and the valuation will be better.
Yep, that's correct, right? Mr. Gerald.
Yeah, so on paper, the scheme consideration is 0.970 per ALOG unit. However, based on actual market price of ESR-REIT at 0.44 cents per unit, some unit holders say ALOG unit holders will only get 0.097 plus 1.7729 times 0.44. Am I right? Right? Or just 0.8771 per ALOG unit?
I believe, a lot of our unit holders are looking at the spot price.
Correct.
But the spot price of any given, of a stock at any given point in time may be subject to market fluctuations and wider macro events. So to have a more balanced view of what is a fair price, what we have done is we have benchmarked the reference price for ESR REITs with the 1 month VWAP per unit to better reflect the traded price of each ESR REIT unit for the 1 month prior to the merger announcement. So we have put in our illustrative scheme consideration value based on the cash consideration of 97 cents, yes, and consideration units of 1.7729 new ESR REIT units, right? So yes, this would be 93.3 cents per ALOG unit based on the 1 month VWAP.
Not 0.8771 cents.
Yeah, that's correct. So we should be looking at least the 1 month VWAP instead of a spot price, because spot price are subject to market value fluctuations, yes, and other macro events happening at that point in time. Yeah.
So let's take the other proxy advisors. Since the merger announcement was made on 15th October 21, you have mentioned that there was no other offers made to ALOG. Your unit holders are also keen to know more on the sales process and whether you have actively looked for a better offer. If not, why you have not. Could it have been possible to invite more? You did not receive any more, you said. But look, this is the best.
Mr. Jared, I mean, the fact is, as of today, we have not received any other offers.
Right.
So again, we want to also explain to our unit holders and emphasize that this proposed transaction is intended as a strategic merger between the two REITs. with a common sponsor, and it's not a complete sell out of ALOG or its underlying assets. So again, both ALOG and ESR-REIT managers have negotiated the proposed terms of the transaction extensively, bearing in mind that the relative valuations of both REITs would need to be balanced from the perspectives of their respective set of unit holders. I would also like to highlight that we have deliberated together with our board on various alternative options, such as whether a direct sale of portfolio assets is possible or a direct sale of the ALOG manager to a third party is possible. But we think that this may not be optimal for a few reasons. First and foremost, ALOG is now trading at more than 30% of above its NAV. So if there is any offer that is meaningful for us to put forth to our unit holders to consider, it has to be above that. And we believe we are already trading at one of the highest NAV, premium over NAV achieved. And if you look at the past S-REIT privatization or mergers, it is already the highest. And this premium above NAV has already reflected the public market premium tagged to logistics assets. So we believe that it is not compelling for us to consider any offers if it is below this NAV, this 40% NAV premium. Secondly, I think the consideration is that any potential acquirers will require debt financing, and this could be limited by the asset valuation of the assets itself. So the potential acquirer will also need to incur additional costs such as stamp duties and potential tax liability for ALOG Australia assets, especially if they cannot qualify for tax shield in Australia. And being, all our assets in Singapore are actually on JTC land. And being on JTC land, there are stringent qualifying criteria imposed on buyers of any JTC properties. So we think the pool of potential buyers may be limited to end users and also entities which hold capital market services license. So hence, we also think that this pool of potential buyers may be quite limited. And furthermore, if the group, ESR group, decides to sell ALOG manager to a third party, ALOG unit holders would cease to have access to the potential pipeline for our sponsors' new economy assets. And this new economy assets pipeline is currently the largest that any S-REIT sponsor is offering to our to its REIT itself. So again, by questioning the sales process, we think we are all missing the point, because this is not a sell-out but a strategic merger. It's not an exit exercise in the first instance. And finally, most importantly, I want to also highlight that the ALOG manager is subject to customary non-solicit obligations under the implementation agreement signed with ESR-REIT. But having said that, such obligation does not prohibit or restrict ALOG from receiving any unsolicited approach, expression of interest, offer or proposal. Should ALOG receive any such bona fide or alternative proposal, the ALOG independent directors remains open to evaluate any other offers and would be obligated under the Singapore Takeover Code to do so anyway. So just to close off on this point, again, I repeat, since the initial announcement of the merger in October last year, ESR-REIT's offer remains the only offer for ALOG units to date.
So the complaint that you did not reach out to the world at large and you should have looked at other offers really is misconceived from what you tell me, So Look, the size of the REIT, I understand, does matter. The overlapping mandates, the merger of the sponsor groups, and the lower cost to have one manager instead of two, I believe can, is good. Can you elaborate more on the new economy assets which the merger will drive? I believe you're taking some very valuable new economy assets to this merger, right?
Yes, for I think moving forward on the growth potential of the enlarged REIT, I think first and foremost, our sponsor is providing us access to 59 billion new economy assets and 10 billion work in progress development assets. The new economy assets, as you can see from past ALOG's performance purely in logistics, has allowed ALOG to re-rate itself in the past. So our focus moving forward will really be focusing on growing the new economy assets in the enlarged REIT. Right now, before we do anything, our combined new economy assets exposure is about 45%, or 65%, pardon me, for the enlarged REIT itself. And we believe that this is the right sector to grow. And we are very confident of going towards this path because there is this available pipeline for us to look at from the sponsors' pipeline.
I believe some of the old economy assets can be converted to new economy assets.
We can do both ways. One is for those non-core assets or non-new economy assets. Adrian and myself will take a hard look at these assets. We may be divesting some of these and recycle the capital to acquire new economy assets. And Mr. Jerry, you're right. There could be opportunities for us to reposition some of these assets into new economy assets if it's possible to do so.
Yes, Karen, you'll be joining this team as a Deputy CEO as well, right? Of this huge.
Yes.
Yes, sir. Yes, we look forward to your continued energy and hard work to make this a success. But I understand you can't provide forward-looking statement, Karen. I fully understand that. But within your constraints and limit, I hope to get some light. But ESR-REIT has about 47% of non-new economy assets. And this is a major concern to ALOG unit holders. So you need to tell your unit holders, how does this marriage benefit ALOG unit holders?
Right. And I think importantly, what we are trying to focus here is combining two small scale REITs into a larger platform. And when we have a larger platform, we have more capacity to acquire larger size transaction. I think the other key point to note here is that both ESR-REIT and ALOG are both already included in the FTSE EPRA Nareit Index. And with this inclusion in the indices itself, we have already enhanced our visibility to institutional investors. At the end of the day, when we talk about acquisition of new economy assets, we believe that with that expanded institutional investors will get more support, especially when we talk about fundraising, for example. And we are also confident that we can continue to expand the exposure in the new economy sector because the sponsor has that pipeline for the enlarged REIT to look at. I think for ALOG's unit holders, like what I've mentioned earlier at the start of this conversation, being a pure play logistics sector has served us well in the last couple of years because of the pandemic. But moving forward, when the economy recovers from the pandemic, it will be beneficial to have a diversified portfolio so that we are able to offer more complete solution to our tenants across the diversified asset class and promote tenant stickiness, and also able to provide that one-stop seamless solution for our tenants to capture the growth in the shift in the demands as the world recovers from the pandemic.
So from all what you've said so far, it appears to me this is a must-have merger. Die must have this, because it's a catalyst. It's going to really speed up your unit holders, opportunity and the company to get a better valuation. Because some of them, there are some pessimists who says that ALOG has been performing well so far, and they're wondering if ALOG can survive on its own, which you just explained why, in the long run, it will be better to merge. There are so many benefits. They say you can do refinancing cheaply, reduce land rent on your own, and acquire the pipeline assets from LOGOS on its own timeline. Just to address this pessimism, what would you say?
I think we acknowledge that ALOG has experienced strong unit price performance and price to NAV expansion since the inclusion of LOGOS as the current sponsor back in April 2021. So we attribute this good performance via the entry of the current sponsor LOGOS and accrediting the benefits of an exclusive sponsor, which brings about added growth trajectory and financial commitment to support ALOG in the past. So the current sponsor LOGOS has already demonstrated these, despite not giving any right of first refusal of LOGOS pipelines to ALOG. However, following the completion of the proposed of the ARA acquisition by ESR, both ESR-REIT and ALOG will now share a common sponsor, right? So to have a committed sponsor who is aligned with the REIT's interest is very important, as you can see from ALOG's growth journey since its rebranding in April 2020. And in the last 12 to 18 months, we have also delivered a strong unit performance. So the current overlapping mandates between both ESR-REIT and ALOG is real. And to be honest, Mr. Gerald, we have also flagged this issue of potential overlapping mandate as one of the consideration for this proposed merger last year in our scheme doc as well, when we first issued it. Some of our unit holders have actually held ALOG units for a long time. So I think it is very important to ensure our unit holders understand our strategy in the enlarged REIT moving forward. And I believe our unit holders have understood and appreciated the business rationale for the merger and the benefits of an enlarged REIT. So that said, I will also emphasize that the potential limitations to ALOG remaining as a standalone REIT while sharing a common sponsor with ESR-REIT will be there. So if we are still going to operate independently, our sponsor would have to split its resources to support the two REITs with overlapping investment mandates. I believe that our sponsor will treat both REITs fairly, but over time, both ESR-REIT and ALOG may not be able to fully leverage the ESR Group's resources for sustainable growth. And we have to compete with each other for the same pool of resources or even the same third-party assets. So this could lead to price wars and increased costs of either REIT acquiring new economy AUM pipeline. So in consideration of this, we don't think that being two standalone REITs is a optimal option for our unit holders on both sides. And don't forget that this merger will also bring together a combination of good talents from two experienced management team to deliver the growth for ELOG or ESR LOGOS REIT. So we believe that the merits of the merger and our experience and our track record and experience in growing the REIT will be valuable for our ALOG unit holders to take note and support us in the transaction.
So you are confident, Karen, that if this merger is successful, you will ensure that the LOGOS expertise in logistics will be retained and leveraged upon. And also you feel there will not be an issue of culture with ESR-REIT.
Yep, that's correct. Yes, first and foremost, I think once we complete the merger, both managers will be working on ensuring that we integrate both teams seamlessly across the core functions and geographies. So that would mean that we not only want to retain LOGOS expertise in logistics, but also to harness the synergies with ESR-REIT and the sponsors' fully integrated platform and strong tenant network, as well as the extensive pipeline that we've been articulating to continue delivering the growth for our unit holders. So the enlarged REIT will be managed by Mr. Adrian Chui as the CEO, and I'm excited to join the enlarged REIT as the Deputy CEO. And we both bring together to the table a very unique skill sets as well.
You're going to be a very busy big lady.
Yes, well, we will have to be very busy.
Good for you. But okay, now, so all years, finally, just round up this whole conversation for the unit holders to give them the assurances that you need to give. What are your final words for them?
Yep. I have been working in the SREIT space for close to 15 years and have I would like to just share that back in April 2020, with the introduction of LOGOS as the new sponsor, I was approached to take up the role as the new ALOG CEO. So at that point in time, the REIT wasn't really trading very well. It was at 0.9 times price to NAV. And it has not grown much, and there were very little institutional investor following. So regardless, I took on the mantle, as I believe that the introduction of a strong sponsor could be the catalyst for change. And we do have a clear plan on what are the next steps we need to take to turn the REIT around. So in the last 12 to 18 months, we took many steps to create value for our unit holders. This includes injection of the sponsors' assets, divestment of non-core assets, this defensive asset enhancement for our Singapore assets, and a painful dilutive rights issue, which was required for us to grow. So back then, I recall there were also skepticism as to how we are going to turn around the REIT with a dilutive acquisition and relatively new sponsor in the REIT space. Again, I believe our clear and sound strategy, articulating the long-term growth plan, and most importantly, delivering what we said we will do, that is the acquisition, divestment, asset enhancements, convince investors we know what we are doing. So action speaks louder than words. So I'm happy to report that we delivered what we promised our unit holders we will do in a short span of 12 to 18 months. And we have done well, as it can be seen in our 79% unit price increase and over 100% total shareholder returns. So having a dedicated sponsor is also part of the reasons for ALOG's success. So all the more with the completion of the ESR acquisition of ARA, now with both ALOG and ESR-REIT sharing the same sponsor, as standalone REITs, we will be in direct competition with each other over tenants, assets, investor interest, and sponsor pipeline. But with a combined platform, we will be able to better leverage on the sponsors' resources and grow more effectively.
And more bigger.
Yes, and Mr. Gerald, I've also spoken to quite a number of our unit holders, both institutional and retail. They have seen and witnessed the growth of ALOG. So I'm happy that, together with my team, we have created value for ALOG unit holders. And we remain committed to do so as the team continue on to the enlarged REIT manager. So I hope, backed by our strong track record, my team and I look forward to work even harder in the enlarged platform together with the ESR-REIT management team.
This is not going to be the end, isn't it? You're going to grow and grow and grow.
Yes, that's right. And we'll work even harder for that.
Okay. But make sure to take some time off for yourself. Don't keep working hard all the time. Okay, Karen?
Thank you,
Look
Mr.
forward.
Gerald.
I wish you all the best and hope you get the good news and your initiative will be successful. You've answered all our hard questions and all the best.
Thank you, Mr. Gerald.
Yeah, bye-bye.
Thank you. Right. Bye.